Your expert is Connell Fullenkamp, a professor of the practice of economics at Duke University. He received his PhD in economics from Harvard University. He has won multiple teaching awards, including Duke's highest honor for undergraduate teaching, and his op-eds have appeared in Newsweek and the New York Times. The financial information provided in this content is for informational purposes only and not for the purpose of providing specific financial advice. Please contact a financial professional to obtain specific financial advice.
I've been a homeowner for over half my life now. That might not be surprising, given that the home ownership rate in the United States has averaged about 64% of households since the 1960s. But I'll never forget that when I was a freshman in college, my macroeconomics professor told the class that we would never be able to afford our own homes. In his defense, the average mortgage rate at the time was 13%. Which made borrowing the money to buy a home extremely expensive. At those rates, a 30-year mortgage with a principal of $100,000 would cost you over $1,100 a month. Fortunately, by the time that my wife and I were ready to buy a home over a decade later, mortgage rates had come down to below 7%. Today, it's soaring property prices rather than interest rates that have probably left a lot of people wondering once again whether they'll ever be able to afford a home. According to Redfin, a real estate broker, as of 2023, the market value of residential real estate in America is over $45 trillion. That's more than the entire U.S. stock market. For most of us who invested in property 20 years ago, we've been repaid several times over. But for those starting out today, is property still a sensible market to invest in? I'm Connell Fullenkamp, and I've been studying financial markets for the better part of 4 decades. And in this course, I want to help you understand the basics of the key markets that shape our economy and provide some insights into how they work and what that means for the average investor, like you or me. This is an introductory course for anyone wanting to improve their basic knowledge of finance, and it pairs well with my other great course on financial literacy. And if after this you find you want to take a deeper dive into the technical aspects of how markets work, I can recommend Akila Weerapana's great course, Macroeconomics Made Clear. Now, you might have expected a course on financial markets to start off with the stock market or the money market. But for most people, the property market is the one that most directly touches their lives. Our homes can represent many things to us, like family and security, but we shouldn't forget that they're also assets. And for most of us, our homes will be our most valuable asset and largest source of wealth, especially in retirement. Because real estate plays such a big role in our financial lives, in this first lecture, I want to ask some important questions about investing in a home. I'll try to keep emotions out of the picture and focus on returns, risks, and the underlying dynamics of the property market, just as we would for stocks, bonds, and other assets in our portfolios. So let's start with a question I posed at the opening. Are homes still a good investment? Well, in just over 2 decades, we've seen the housing price boom of the mid-2000s, followed by the great housing bust of 2006 through 2008, and now the pandemic housing boom, which has seen house prices soar since 2020. Given this experience, it's just not clear whether buying a home is going to give a solid return, or even a positive return anymore. The only way to sort this out is to get some data on home prices and calculate some returns based on these prices. I downloaded data on the Case-Shiller U.S. National Home Price Index, which has tracked the average home price in America since 1987. If we look at the index values over time, we clearly see the acceleration of house prices in the early 2000s, the peak in late 2006 and early 2007, and then the rapid fall during the financial crisis of 2008 and 2009. Home prices continued to drift down for several years after that. But prices started rising again in the mid-2010s, followed by the tremendous increase in prices during the pandemic. Home prices increased even faster than they did during the boom in the early 2000s, which raises the possibility that there may be another bust on the horizon. My concern is that these big price swings can greatly reduce the return on buying a home, and if your timing is unlucky, they could make a home purchase a losing investment. But let's try to get a feel for the average returns on buying a home, as well as the riskiness of this investment. For example, let's pretend to buy a home on January 1st, 1987, and assume we own the home for 5 years and then sell it. We can use the change in the Case-Shiller index to calculate the average annual increase in home prices during this period. And then we can move to February 1st, 1987 and repeat the calculation and continue doing this up until 5 years ago. So this graph shows you what the average annual capital gain on a home would have been in percentage terms, assuming that you bought the home on the date on the horizontal axis and sold the home exactly 5 years later. The graph shows that in general, the returns to investing in a home were positive, and it sometimes were pretty good, rising to just over 10% if you bought a home in early 2001 and held it for 5 years. That was the average annual capital gain, remember, so your total capital gain would have been about 64% over the 5-year period. The graph also shows that there was a 4.5-year period bracketing the global financial crisis when buying a home and holding it for 5 years was a losing investment, and some people would really have lost big. But 5 years is a fairly short time to own a home. What happens if we increase the amount of time that you stay in the home before selling it? I redid my calculations on the assumption that you stay in the home 10 years before selling, and the picture changes in a significant way. Here's the graph. Now the historical data says that if you hold the home for 10 years, there was only one very short period in which you would have lost money, and that is if you bought a home between mid-2005 and the end of 2006. And even then, the worst average annual return was a loss of less than 0.4%. It's never great to lose money on an investment, but most of us can bear a loss of that scale. Keep in mind that if you take out a mortgage on a home and pay that mortgage for 10 years, you'll accumulate equity in the home. So there's a good chance that the equity you accumulate would more than compensate for the decline in the value of the house. And the picture gets even better if we calculate the average return over a 20-year period. I've done that as well, and here's the graph. Notice that when we look at 20-year returns on buying a house, not only are there no losses on average, but the minimum average return is just under 3% per year. And this doesn't include the other return you get from owning a home, which is the housing services themselves. In other words, you don't have to pay rent, and this adds a significant amount to the effective return to owning a home as well. My interpretation of these numbers is that over the long haul, investing in a home still does provide good returns, even when the market goes through significant booms and busts. In other words, houses seem like they do hold their value well if you can hold on to a single house for a long period of time. But the shorter the period you own the home, the greater is the risk that you might lose money on that investment. This return profile is actually pretty similar to stock investing, which we'll cover in a later lecture. In both the stock market and the market for homes, the longer a person stays invested, the lower the risk of losing money seems to be. And that's because every market, whether it's for property, stocks, or even baseball cards, can be infected by bubbles. A bubble occurs when market prices for an asset rise far beyond that asset's underlying value. And a bubble is, by definition, unsustainable. When they eventually burst, prices will crash and then readjust to more realistic levels. As we know, the financial crisis of the late 2000s was the result of the bursting of a real estate bubble, which was driven in large part by reckless lending practices that led to too many people buying houses they couldn't afford at prices that weren't sustainable. Bubbles are temporary. The longer your time scale, the less significant they are in the scheme of things. No one wants to buy at the height of a bubble, of course, but they aren't always easy to spot. There are many valid reasons why prices for an asset might start trending upwards, and you don't want to hold off on making an investment hoping for a fall in prices that may never come either. So, are the increasing real estate prices of recent years indicative of another housing market bubble? Well, let's consider some of the trends that are driving house prices over the medium term. The first trend that comes to mind is the retirement of the baby boom generation. One worry is that as this generation moves into apartments, condominiums, and assisted living facilities, it may create a glut of houses on the market that depresses prices. That's definitely a concern, but I think there are other trends that will mitigate or even completely offset it. The first one is that even though population growth is falling, people want more housing, both in terms of more space per person and in terms of multiple homes. The rise of remote work has created more demand for larger houses with home offices, for example. But even more important, I think, is the fact that America and most developed nations have underinvested in building new homes for nearly 2 decades now. The rate of new home construction fell dramatically after the global financial crisis and didn't fully recover. And the COVID-19 pandemic was another major setback for home construction. This means that the growth in the number of homes hasn't kept pace with the growth of the population, and we have a home shortage. There are different estimates of the size of the shortfall, but a conservative estimate is still over 1.5 million houses. To put that in perspective, the total inventory of houses available for sale at any given time is around 1 million homes, so a shortfall of 1.5 million homes or more is huge. And the US isn't the worst example. In the United Kingdom, for instance, the housing shortfall exceeds 4 million homes. And some commentators have started to observe a global housing shortage. In that case, an increase in existing homes coming onto the market as baby boomers move out of them would actually be welcome. I should add a caveat about location, though. The homes we need aren't necessarily where we want them to be, and some areas will experience housing gluts while others will have severe shortages. In broad terms, there's an ongoing migration from the Northeast and Midwest of the United States to the Sun Belt that shows no signs of letting up. In addition, for more than a century, most of the world has been moving from rural to urban areas. But in many megacities like New York, London, and Hong Kong, there are now real limits to the amount of new housing that can be created due to a lack of available land and development controls. So if I were thinking about whether purchasing a home was a good investment, I'd get some numbers about local demographics and the area's longer-term economic outlook. Demographics in construction aren't the only trends that shape the real estate market, of course. Real estate prices are closely linked with the health of the overall economy and interest rates, because most home buying and mortgage repayment is backed by personal incomes. When wages rise and unemployment falls, more people can afford to start entering the housing market. Despite a major spike during the height of the COVID-19 pandemic, unemployment across the Organization for Economic Cooperation and Development, or OECD, has been at historically low levels over the past decade, as have interest rates, making mortgages, even at fairly high amounts, affordable for new generations of homebuyers. Much tighter lending practices introduced after the 2007-2008 crisis means it's more likely that, even if a recession hits, mortgage default rates are not as likely to skyrocket as they did back then. Yet another trend in the housing market worth considering is the entry of institutional investors. Before the global financial crisis, most of the businesses who purchased homes were sole proprietors. Buying a house in your neighborhood or town and renting it out has always been a relatively easy way to go into business for yourself, especially on a part-time basis for additional income. But the crisis made investing in single-family homes attractive to big investors like fund managers for the first time. Prices fell dramatically during this period, which meant that many houses represented great opportunities for value-oriented investors. And just as important, because of widespread defaults, there weren't merely a few extra houses coming onto the market here and there. There were hundreds of houses being auctioned off at a time in many cities, and in some cases like Phoenix in Ireland, literally thousands. This meant that it became possible for large institutions to invest on a scale that made the opportunity worth their while. We're talking tens or hundreds of millions of dollars at a time. What makes this significant for our discussion is that the institutional investors have largely followed the same strategy as the mom-and-pop investors who buy single-family homes. That is, they turn the homes into rentals instead of trying to resell them for a profit. One of the most important types of institutional investor in the market for homes is the Real Estate Investment Trust, or REIT for short. This type of fund can sell shares to individual investors and must pay out 90% of its earnings to the shareholders in the REIT. Thanks to the entry of institutional investors, there's now an entire class of REITs called SFR REITs, where the SFR stands for Single Family Rental. Two of the largest in America are Invitation Homes and American Homes for Rent. And in Europe, some REITs are truly staggering. Germany's Vonovia owns more than 500,000 apartments. If I were thinking about getting into the landlord business, I'd look into investing in these funds first, since I'd get a lot of the income and portfolio diversification benefits of being a landlord without having to deal with actual tenants. Once institutional investors moved in, so to speak, they decided they liked this business. They've continued to accumulate properties, and I think they're going to be a permanent feature of the market for houses. For those of us who are interested in owning homes, I think this is good news. Their presence means that if house prices do start to fall significantly, they'll be ready to do some bargain hunting and put a floor under the market. So it's possible that we won't see home prices fall as steeply as we did during the global financial crisis. In addition, they may also permanently play a part in increasing the share of homes that are rented rather than owner-occupied. This may also help support home prices in the long run. However, they are not without their critics either. Some commentators have decried the rise of speculation in the housing market, where investors buy homes and apartments with the intent of simply holding them for a time and then selling them again for a profit, without bothering to take on renters. And some investment companies have specifically sought to buy houses for the purpose of short-term and holiday rentals, something increasingly popular through platforms like Airbnb. Investment of this nature takes housing stock out of an already tight market, driving up rents. In 2022, the Australian census data revealed more than 1 million houses were unoccupied across the country on census night, a figure that angered many in a country facing a major housing shortfall. Of course, some of these unoccupied homes were just temporarily unoccupied because they were being readied for sale. So let's talk a bit about flipping, another popular way of investing in the housing market. Buying a house with the intention of reselling it quickly, possibly after making some improvements, became a national sport during the housing boom of the mid-2000s. And judging by the number of reality shows about people who do this for a living, it's still quite popular. I can't bear to watch those shows, or just about any other show about real estate, but my wife finds them fascinating. At least I get some work done while she watches them. But according to the real estate data company Atom, about one home sale in 15 is a house flip, since the sale occurred within 12 months of its most recent previous sale. And in 2022, about 8% of home sales were house flips, which is the highest rate recorded since records began in 2005. So house flipping is a small but increasingly significant part of the market. The attraction of house flipping is the possibility to earn a high return quickly. And the numbers appear to support the idea that the returns can be high. According to the Atom data, the average return on investment from house flipping in the US has varied between about 25 and 48% since 2005, which seems quite high. But this return doesn't take into account any financing costs that you may have incurred to acquire the house, property taxes, or renovation costs. So the net return is going to be a lot lower. In addition, the data that people present on the returns to house flipping are full of what economists call survivorship bias. That is, we only use numbers on profits that come from successful attempts to flip houses. We don't know how many unsuccessful flipping attempts also happened. Let me just say that I find the reported numbers on house flipping profits a bit overstated and leave it at that. Because there's a ton of risk that goes into house flipping, and from my reading of websites on house flipping and the academic research on it as well, I'm convinced that the key to successful house flipping is all in the price you pay for the house. The rule of thumb that people mention is that a house flipper should pay no more than 70% of the price they expect to get, less the renovation costs they expect to pay. And that's the maximum. So a successful house flipper has to be able to drive a very hard bargain on any house they buy. And even then, it's no guarantee of success. At the end of the day, I'm pretty sure that I can earn much better risk-adjusted returns from becoming a landlord myself or buying into REITs. The fate of the online real estate companies that got into house flipping only supports my point. Zillow and Redfin, two otherwise very successful online real estate brokers, got into the business of house flipping starting in 2018. As part of their main business, they had developed the ability to assign a current market value to anyone's home. Then they also had developed software that predicted the future prices of homes and used this ability as the basis of a business to purchase homes and then resell them. Zillow called its business Zillow Offers, and it was technically a market-making service, acting as a home dealer, but in reality, the business would be profitable if it helped Zillow flip houses. It turned out, though, that Zillow and Redfin didn't have as good an ability to predict future home prices as they had hoped. Zillow closed down Zillow Offers in late 2021, and Redfin followed the next year, after major losses in the house flipping business. I shouldn't be surprised that the online platforms have a hard time earning profits on house flipping, given my argument that the key is to make a super low bid for the house when you buy it. Think about it. Zillow's claim to fame is that they can tell you the true price for your home right now, and then to earn a profit, they have to turn around and make an offer for your home that is very low. That just isn't going to work very well. Now that we've talked about whether buying your own home is a good investment, and whether buying homes purely as an investment makes sense, we should also talk about getting your money out of a home investment and using that value for other purposes, like funding your retirement. One of the ways that's available to every homeowner who has accumulated equity is a home equity loan or home equity line of credit, also known as a HELOC. These can be very flexible and convenient and carry attractive interest rates. Another approach is to refinance your home and convert some of your equity to cash using what's known as cash-out refinancing. For example, suppose I purchased a home years ago for $200,000 using a $20,000 down payment and a $180,000 mortgage. After 20 years of paying the mortgage and some positive price appreciation, my home may now be worth $350,000 and I only owe $50,000 on the mortgage. That means that my home equity has risen to $300,000. I could conceivably take out another $180,000 mortgage, pay off the remaining $50,000 balance on the old mortgage, and have $130,000 cash to do whatever I want with. And if the interest rate on the new mortgage hasn't changed much from the rate on the old mortgage, my monthly payment doesn't change at all. On top of that, the interest is still tax deductible. As I indicated, cash-out refinancings make sense when interest rates haven't changed much, or better yet, have fallen. If interest rates have risen since I took out the old mortgage, I would have to do the math carefully and decide whether the higher interest rate on the new mortgage negates the benefit from being able to access the increased equity in the house. One other product that is often mentioned but not used that much is the so-called reverse mortgage. The way that a reverse mortgage works is that the homeowner borrows against some of the accumulated equity in their home, but they don't make any payments while they're alive and still live in the home. Instead, the amount borrowed accumulates interest. The principal plus all accumulated interest is paid off when the homeowner either dies or sells the home. A reverse mortgage would be useful and attractive to me if my home had a lot of equity in it, but I didn't have very much post-retirement income or other savings. In addition, it would make sense only if I intended to stay in my house for the rest of my life and didn't care about leaving a bequest to my surviving family. But notice that the amount I can borrow will be limited by the fact that interest accumulates on my balance until I die or move. If I live a long time, the compounding of interest would make the total balance on the loan quite large, like a credit card bill on which only the minimum balance is paid. This danger reduces the amount that lenders are willing to advance me for a reverse mortgage. So a reverse mortgage can be a good tool to convert home equity to cash for people with few options and who are determined to remain in their homes. But I think there are better ways to use my home equity to fund my retirement. For example, if I sell my home, I can turn around and purchase an annuity to fund my retirement. In many countries, including the US, a large amount of capital gain on home sales is exempted from tax if the seller has been living in the house for a certain period. Of course, to do that, I have to be willing to sell my home and find a new place to live. I realize that for many people, the decision to leave your home can be wrenching. And that leads me to my final thought about the market for homes. One of the most important financial decisions that my wife and I made together was that we would resist the temptation to overinvest in real estate. When we were pre-qualified for mortgages, realtors were eager to show us all the homes that had us borrowing the maximum amount possible. On at least one occasion, a realtor stopped working with us when we told the person that we were looking for something that cost significantly less than our pre-qualified amount. But by spending less on homes, we gain something that's at least as valuable as a good place to live: financial flexibility. We had room in our budget for more saving, to handle the emergencies that came along, and to pay down our mortgage faster. And we've still lived in homes we've loved, in great locations, with plenty of room for our 3 kids. I'm not claiming that it's always possible for people to avoid stretching their finances to invest in a home, especially if you work in an expensive location. But if you have the opportunity, think carefully about the size of your investment in real estate and how it affects your other financial goals. Though every market is different, one principle that should guide your approach to any of them is caution. With every market comes risk and unpredictability, and the investor who is informed and flexible is the one most likely to navigate them successfully.